So now looking at balance sheets, and we need to be able to know what the terms fixed assets and current assets mean, know what long-term liabilities and current liabilities are. Technically speaking, actually, the balance sheets that you'll look at don't have long-term liabilities included on them, but I usually teach my AS groups that because it makes it easy when you do the A2 stuff. We need to know what debtors, creditors, drawings are and give examples. We need to calculate net current assets, calculate current assets, net assets as well. We need to know why working capital is important for the business and look at the stakeholders who would be interested in these accounts. So not just balance sheets, but the profit and loss and maybe the cash flow as well. So a balance sheet basically contains information about the assets of a business, its liabilities, and its capital. By capital, I mean what's been invested into it. So sometimes it's listed as equity as well. So it's a little bit like a photograph of the financial position of a business at a certain point in time. And it can inform you about the value of the business as well. And this is the balance sheet equation. So assets minus liabilities should equal the capital that's been invested into the business. Okay, so we'll go through what assets and liabilities are now. And because you're doing AS and it's technically on the specification, it's understanding and being able to interpret the balance sheets of sole traders and partnerships. It's usually called the financed by section, but I'll point it out when we have a look at it. So assets are just resources that a business owns or uses. So we have kind of machinery and cash and computers and stock there. But we have two types of assets. Now, technically, international accounting language, they're called non-current assets, but we're a bit behind the times, really, with Welsh Board. So we call them fixed assets. And these are things that are expected to last for at least 1 year, so over a year. And they're not, it's not sort of stock that's, been bought to resell on. It's equipment that's used to produce your products, so machinery, buildings, fixtures and fittings. Whereas current assets they're going to have a short life in the business, less than 1 year, and they're also, we call them liquid as well. They're going to be converted into cash quite quickly. So if you think about your life, you might have lots of different assets. So I have a bit of stock. I have a few lessons up my sleeve prepared, so I could call that stock. I have furniture at home, clothes. I used to own a car that looked like this. That was my first car and it was very nice. I got rid of that a long time ago. I have more furniture at home, more furniture. Yeah, rubbish IKEA furniture. I have loads of that, and I might have a little bit of money in my purse. Not that much though, like 50p. And I also have some money in my bank account. However, on the other side of things, liabilities is money that the business owes to others. So we could have, the two different types of liabilities are long-term liabilities, so money owed by the business that will not be repaid after a year. So they're still going to be paying it off after a year. So it could be bank loans, mortgages. And then current liabilities, so it's money owed by the firm which will be repaid during this year. So creditors, so that's suppliers that you owe money to because you've taken receipt of the items that you ordered but you've not paid them yet. And bank overdrafts. So liabilities I do on credit cards, and I think I do owe some money on it actually. That's just reminded me. I don't have a gas bill at the moment that I owe, but I do have a water bill that I owe. And a mortgage and a student loan and council tax. Have that at the moment. I just got a letter about that actually, so better pay it. Okay, capital financed by is the money that's been invested into the business, so opening capital, and then maybe money that you've made, net profit, maybe that's been reinvested into the business, minus out any drawings. So drawings are not pretty pictures in this case. It's money that's taken out of the business by the owner, usually to pay their own salary. So I've put a picture of an entrepreneur there, Branson, to show you, that would be kind of the money he'd invested. So net profit there, often called retained profit for LTDs and PLCs, but because we're looking at sole traders, usually for the AS question, sole traders, I don't think there's ever been a question on partners balance sheets, but it could come up. But it's called net profit on theirs. Drawings, money taken out of the business by the owner. Okay, so here is our balance sheet, and we can see at the top fixed assets are there. We've got a vehicle and fixtures and fittings, so that's £15,000. I'm going to get my pen out so I can circle something as I talk. So that's just adding up those things. And then here are current assets. So we've got some stock, we've got some money some money from some people that owe us things. So those are customers, usually debtors who owe you money. They've taken receipt of the products that you've sold them, but they haven't actually given you the money. So it's money owed to you. Your bank account and your cash in hand. Not literally like cash you actually literally have in your hand. It means what cash have you got in your till. And then less current liabilities. They're not called less current liabilities. It's just there to remind you, to give you a helping hint that these are going to be negative figures actually. And if we add these up, so creditors, these are suppliers that you owe money to, and your overdraft, so £25,000. So working capital, also known as, can I draw on this, net current assets. And net just means that you're taking something away from something else. So net, look at my skills on the mouse, net current assets. There we go. Also known, usually they put it in the balance sheet for you, net current assets, £20,000. So how would we have got that? Well, it's current assets, so £45,000 minus our current liabilities, so £25,000, which equals £20,000. Yay! Right answer. Okay, and then net assets is just your total assets, so your fixed assets plus current liabilities, minus fixed assets plus current assets, minus your current liabilities, or less your current liabilities. So 15,000 add 45,000 would give you 60,000, and then minus out 25,000 will give you 35,000. Okay. So that's how you get that number, and that's usually the number that's like kind of deleted out, and you have to kind of work it out. So basically, that's like the top of the balance sheet, okay. And then this bottom part, this is here at the top actually. Before I go on, this top part, your assets, your fixed assets, and your current assets. This just points out what your business has spent its money on. So in terms of fixed assets, what have they where have they spent it buying kind of vehicles and equipment and your buildings and stuff. And then your current assets is where the money's gone on stocks, or if you haven't even done anything with the money and it's just in the bank account. Whereas down here is the money that you owe to other businesses, and then you get these calculations here. Here we have finance by, so this just is pointing out how much money is being invested into the business. So opening capital here is showing how much money's previously been invested. And then if we add in net profit, this was the net profit made, this has come from the profit and loss account. So if we add that in, and then actually this owner wants to withdraw. If you think of drawings as like withdrawings, they want to withdraw some money from the business. So to work out capital employed on this, it's just your opening capital plus net profit minus or less out. That's why they're giving you these things in brackets to kind of hint to you what you should be doing. Minus out your drawings equals your capital employed, and it's just basically saying how much money capital employed is saying, or finance is saying, how much money has been invested into your business. Now, if you remember from the beginning, this account is called a balance sheet, and look what happens. It balances. Okay, so if these figures here, if net assets doesn't balance with what's at the bottom of your balance sheet, you've done something wrong, so go back again. Now, just a word of warning, if you're looking at the A2 course, if you're maybe resitting it, and capital employed, some places work it out a little bit differently, but capital employed at the A2, you'd include your long-term liability, so it might not actually equal the same as your net assets, but your equity should equal, or your capital or finance by should equal the same as your net assets. But if you're just doing the AS course, you've not done the A2, don't worry about that just yet. But if it doesn't balance, you've worked out something wrong, but those two figures should equal the same, because basically you're saying the money that you've invested into your business is what your business is worth, in terms of what you own and what you owe. Okay, so there we go. Assets minus liabilities equals your capital. Okay, just a quick overview. This is often a 6-mark question about who would be interested, what stakeholders would be interested in the accounts of a business. So if you just think through your stakeholders, so we could say sometimes the question is external stakeholders as well, which makes it a little bit more complicated. But why would a bank be interested in the accounts of a business? Well, they'd be interested in looking at the cash flow statement to see if they can afford to pay back any loans, and they'd be looking at working capital as well, which is your net current assets, so current assets minus current liabilities, because that's the money you have for the day-to-day running of your business. And if you can't pay that, if you don't have very much of that, which this business seems to have quite a fair bit, so it's quite good, you wouldn't be able to pay your suppliers and you wouldn't be able to pay any bank loans back, so they'd be very interested in that. An investor might be interested in the balance sheet to see how much the company's worth. They might be interested in the profit and loss account as well to see if it's worth investing, what type of return they'd get from this. Maybe the owners, the actual owners themselves would be interested in these accounts to kind of measure the performance of their business. Maybe the employees, some employees might be interested because they might want to work out if their job's secure or not. Suppliers might be interested as well because they want to know whether you're going to be able to pay them for the products that they sell to you. Some customers might be interested. It's usually more B2B customers that be interested because they want to know that if they order from you, you're not going to go out of business and take their money and not deliver the product. Okay, so if I just do a brief overview, so fixed assets and current assets. So fixed assets, anything the business owns that won't be used up in the next year and that's used to generate products and help them produce products. And current assets is things that the business own that are going to be used up in the next year. And current liabilities are debts of the business that they owe to other businesses, such as banks or to their creditors. Debtors are people that owe the business money, whereas creditors, so these are usually your customers that just haven't paid yet, and the creditors are people that you owe money to, so these are usually your suppliers. Drawings is the money taken out of the business by the owner. It's usually to pay their own salary. Net current assets or working capital is current assets minus current liabilities, and that's the money that you have for the day-to-day running of a business. Working capital is important for a business because that helps you pay your day-to-day costs, so suppliers and your workers and banks. And we've just run through the stakeholders that are interested, so I'm sure you can remember that far back.